Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I don't know if you can say as always. Last week you weren't here.
That's true.
And God, what a few weeks you missed.
Yes.
It was, there was a lot happening.
Yeah.
But it's good to see you back.
Thank you. Good to be back.
Tanned, refreshed.
Yes, feeling
Yeah.
good. Yeah,
Yeah.
a bit of time in Indonesia.
Yeah.
Getting some sun, some surf. Well, no surf. Watched a lot of surfers, though.
Okay.
Saw one guy absolutely take a barrel on the reef and came out with, I reckon, requiring maybe 20 or 30 stitches down the front of his calf.
Oh, wow.
Yeah, got absolutely hammered. But hope he had travel insurance. But yes, it's been nice. I've come back day one. The show notes are full of some crazy things that have been happening in markets.
Yeah, lots been going on.
So I'm looking forward to unpacking it.
Well, in today's episode, we're going to talk about the news of the moment, what's been happening and what might happen next. Then we're going to talk about this month's book club book and some of the big takeaways from that, 3 big learnings. And then finally, I went to the JP Morgan quarterly briefing
Nice.
while you were away, and
Yeah.
there were some big takeaways that I want to share with you and everyone listening.
Which notably has, I reckon, Sydney's best avocado on toast.
No, okay, so to peel back the curtain for people listening, the avocado on toast is like a big thing that you and Simon has always talk about. Unfortunately, it's a morning briefing and I try and do this intermittent fasting thing.
No.
So I've never actually tried the avocado on toast.
Oh.
But Liv came with us, came with
nice.
me this time because
Yeah.
you and Simo were both away.
Yeah.
No avocado
Oh,
toast.
you're kidding.
So she was very disappointed.
Damn it. Well, I think we have JP coming in at some point this week, so we'll have to have a chat to them about it. But Ren, let's kick off at the top. What's been happening?
News and markets.
All right, well, let me start with a question for you. How much are you aware of? Like, what did you catch while you were away? How much do we need to catch you up on?
I know that Australia have been doing incredibly well in the Olympics. I've been following that.
Yeah,
which has been
best Olympics ever now.
Love to
Yeah.
see it. Love to see it. And in terms of market news, I'm aware of the recent RBA decision, and mainly through social media. But the markets have been pretty volatile over the last couple of weeks.
Yeah. Although the last few days, it's really calmed down. So,
Didn't check my portfolio once, so
Good.
I don't know if I should. But I have seen, mainly through the Equity Mates community on Facebook, a lot of people concerned with what's going on or surprised. So yeah, take me through it. What's the latest?
look, I don't think the financial media have covered themselves in glory this past week. And I know we're part of the financial media, but the panic and sensationalized headlines really hit fever pitch. And Simon and I broke a lot of this down in great detail on Thursday's episode, so you can go back and listen to that. But at a very high level,
Yeah.
one crazy jobs report led to
US.
a lot. Yeah.
Okay.
I mean, it wasn't just that. There was this Japan carry trade that was unwound and a few other things. The story has been the US is going through earnings season. Some of the tech companies had started getting sold off a little bit because they were disappointing. They were still growing, but just a little disappointing. So there was a little bit of like apprehension in the air. And then this US jobs report comes out. It's weaker than expected. Unemployment is higher than expected, up to 4.3%. And everyone was like, okay, the US is on for a recession.
Yeah.
And there was a bit of panic.
Yeah.
Here in Australia, a couple of Fridays ago, the market fell 2.1%, which was our worst day in like 18 months.
Yeah.
Then the US followed down 2% that night. Then on Monday in Australia, we fell 3.6%.
Wow.
That made it our worst 2-day stretch in 2 years. Then the US followed down 3%. And so everyone was, that was when the panic, there was a news.com.au headline, I remember, nowhere to hide was the headline. Like 56 billion wiped off the ASX or something. It's like, that was the kind of fever pitch that the media got us to. Simo and I were talking about how the ABC moved their finance bulletin right up to the top of the news coverage, and it was all like panic.
Yeah.
Meanwhile, in Japan, something completely unprecedented, well, at least since 1987, The Nikkei 225, their index, was down 13% in a day.
Whoa.
Yeah.
Whoa.
Yeah.
Did it bounce?
Back up 10% the next day.
Wow.
Now, the US story and the Australia story are more because of there's more long-term implications for us. It's because there's concern about the weakness in the economy and the potential for a recession. Japan was quite idiosyncratic. It was quite unique. Japanese interest rates have been quite low compared to the rest of the world. So a lot of global investors borrowed in yen and then went out and bought assets around the world. Like classic example, Berkshire Hathaway did a bond issue in yen. Yen denominated debt, you had less repayments than you could go and buy assets in other markets.
Yeah.
But asset prices fell just as the Bank of Japan were raising rates and the yen was getting stronger. And so all of these global investors started getting margin called.
Yeah.
And so they had to unwind that trade, dump assets, put money back in their lenders' pockets, essentially. That was less structural and more like the unwinding of this big trade.
Wow.
But that happened in Japan at the same time. Now, since then, everything has kind of calmed down. So then, Australia was up 0.5%, then the US was up 1%, then Australia was up 0.5% again. Last night, time of recording, the US was down 0.7%. So it doesn't mean we're out of the woods yet, but it's kind of like a bit of normalcy's returned. And so looking back, we had 2 or 3 really bad days and everyone lost their minds. Yeah. And now it's kind of...
Yeah, it just reminds me, I'm pretty sure just before I went away, we did an episode. The first segment was doesn't the stock market always crash? And we went through the numbers that went one in every, 1.7 years or even less, 1.2 years or something, the market has a pullback of 10% I
feel like I've had these numbers from Morgan Housel on repeat. These are US numbers, but going back to 1928, same principles apply in Australia. On average, the US market falls 10% every 11 months.
There you go.
Yeah.
So, and this wasn't even 10%.
No.
Yeah. So everyone needs to relax.
Yeah.
It's all financial media. It's funny, isn't it? I think in that segment as well, we made a point that the ABC's never dragging its finance report to the top when we have a string of 10 wonderful days.
So
the bounce back will never be at the top.
So here's the best example of that, and this is the example to keep in mind next time. So that first Friday where the ASX fell 2.1% and it was the worst day in 18 months. The financial media lost their mind, terrible, $50 billion wiped out. Those were the headlines. If you zoom out just to a week, the ASX 200 was still up 0.3% for that week.
Go. Wow.
The Wednesday was our best day in 2 years. No one was losing their minds about how good that was. And on Thursday, the ASX 200 hit an all-time high. So,
no way.
Yeah, it is just that. We need to keep that perspective. We're going to keep repeating it because it's important.
But that's the markets. What else has happened?
Okay, I'll just rattle them off quickly. You interrupt if you want to chat about it. Both the Fed and the RBA held rates.
Yes.
Michelle Bullock, the RBA governor, said on current information, she's not going to cut in the next 6 months.
Yeah. Was that primarily driven? I think it was a day before, or the week before rates. It came out that inflation was instead of 4.14 or instead of 3.9 or something like that.
Yeah. So inflation was 4% 12 months to June, and then it was 3.8 12 months to July.
Yeah. For me, that's it's nothing.
It's not back in the target range.
Exactly.
I know.
It's not in the target range. So what are they doing? I get it, but I just think anyway, I was surprised they held.
You thought they should have raised.
Yeah.
I feel like the next move might be up, but we are certainly the outliers.
Yeah.
All the big economists are doing the rounds on the news saying they're going to cut. Yeah.
But this is what I also find completely contradictory. I was talking to Harriet about it when we were at breakfast in Indonesia.
She must have loved that.
Is that a month before the numbers were 0.02 or whatever higher, 4, let's call it 4%. And everyone was like, they've got to raise rates. They're going to raise rates. They're going to raise rates. Yeah. A month later, the most minute change.
Yeah, I know.
I can't believe it.
Yeah, I know. But overseas, the Bank of England cut, European Central Bank cut, Canadian Central Bank cut, and the US is all but certain to cut in September.
Yep.
The question is now, will they do 25 basis points or 50 basis points.
Have they done enough?
So Australia is kind of out of step with the rest of the world, which will be a developing story for the rest of the year. Rex, the airline, went into administration. Did you see this? Yeah.
So devastated because I'm booked into Rex to fly to Brisbane later this year, so that's been cancelled, and you now have to get put on a Virgin flight, but they have to work through it. B, I'm glad that the government stepped in and said you must continue with regional.
Yeah, I know.
Because that's how we fly to Wagga, and if they disappear and you're stuck with Qantas, like, it is prohibitively expensive.
Yeah.
So I'm glad that they've said, guys, what are you doing? Sack the routes between major cities and stay regional.
Yeah. The Transport Minister has come out and said they'll bail Rex out if needed as well for regional transport.
Yeah. Gotta happen.
Yeah. This story has it's flown a little bit under the radar, but it's worth paying attention to. Western Australian mining is getting absolutely whacked at the moment. So the lithium price has tanked, the nickel price has tanked, and iron ore has fallen. Over 7,000 jobs in WA mining have been lost this year. BHP suspended their Nickel West operation back in July. Albemarle, while you were gone, cut 300 jobs and shut down half of their refining plant in WA.
And this time last year, they were trying to buy Liontown.
Yeah. Liontown is now 2/3 cheaper as well. So,
wow.
MinRes earlier this week said they were cutting 100 jobs and suspending operations at a iron ore mine and not continuing with planned lithium expansion. So mining is having a really tough time at the moment. Yeah.
Interesting.
And then final one overseas, Neuralink.
Oh yeah.
Inserted
Elon
a second brain chip.
Oh wow.
Yeah. They plan to do 8 more this year. I was looking up, and I included this in our daily news email. The first guy who had his brain chip implanted in January can still control a computer with his mind, which is pretty cool. A number of the electrodes that were connected to his brain have detached, but there's still enough connected that it still works.
Jeez.
But apparently now, for the first one, they went like 3 to 5 millimeters deep, and this one they're going to go 8 millimeters deep or something like that. Yeah. But it's
crazy what this guy's doing.
It's happening. Yeah.
It's crazy. Yeah. I saw one of our mates was over in San Francisco and put up a story of him getting into a driverless taxi as well.
Oh, nice.
Which was
cool.
pretty epic. Wow. Well, there you go. Thank you for that.
Yeah, that's
Back
all right.
up to speed.
Do you feel up to speed?
Yes.
Look, if you want to feel up to speed, you can also sign up for our daily news email. We're loving doing it. A short, sharp summary of the day, and then one longer form thing to make you a better investor. So sign up to that. The link will be in the show notes. But Bryce, let's pause there and then come back with this month's book club. All right, Bryce, book club this month. Yep. Let's play the sting.
Book club.
So the book this month, Traffic, Genius, Rivalry and Delusion in the $1 billion race to go viral by Ben Smith.
Yeah. Haven't read it, but I obviously, because
that's the premise of this segment. All right, so I've got 3 big learnings for you.
Okay, and because I want to go viral.
Yeah. Within those learnings, I'll sort of tell the story of the book.
Okay.
And I should say that this is with our investor hat on. Okay. Not our media executive hat on.
Okay.
Yeah. So number 1, there are no barriers to entry in media anymore. Mm-hmm. So this book follows the story of these digital media companies that sort of sprung up late 90s, early 2000s and beyond. Huffington Post, BuzzFeed, Gawker, Valleywag, Jezebel, Deadspin, Gizmodo, TechCrunch, Drudge Report, Breitbart, Politico, Upworthy. Any of those names sort of...
Yeah, definitely a few of them do.
Yeah. And so they it starts with the sort of the prime blogging years, call it, of 2000 to 2008, pre-social media dominance. And a lot of the ones of that list that I spoke about that spun up in that time were just websites. They just were websites, 1 or 2 people, spun up, started attracting traffic, no major capital costs, just good and often very cheap people. What you can sort of learn from the media business is that with barriers to entry this low, just spin up a website and start writing, and all content being equal on the internet, you know, like a deeply reported New York Times investigative report and a BuzzFeed 45 photos that will make you go, oh, like they have equal footing and equal billing on the internet.
Yes,
Like it's
yeah.
a great equalizer. It just means that the lowest cost content wins, because you know, like that's what you can do profitably and cheaply and quickly, and do more of it. And so to give you a sense of how the media business works, an example from BuzzFeed, they did an article, 45 most powerful images of 2011. It got 3 million views in 3 days. And if I make it up, call it a $20 CPM back in those days, which is cost per 1,000 impressions, they would have made 60 grand from that article.
Yeah.
Yeah. And, you know,
Pretty
like
decent.
that's pretty good. But then, you know, if you compare that to what the New York Times has to pay to do some of their reporting.
Worlds apart.
That's why low cost content wins, or was winning back then. The other thing that you very quickly learn with a lot of these blogs is that when barriers to entry are this low, your decency is someone else's opportunity. And what I mean by that is, like, a lot of the legacy media companies had journalistic standards and things that they wouldn't report on. And so a lot of these companies, especially the Gawker companies, they just came through and were just like,
let's rip it.
yeah, like if it's going to get clicks, we'll do it.
Yeah.
There's one example in the book. Brett Favre, the quarterback, sent inappropriate pictures, and the media had them, but no one was publishing them. So then one of the Gawker websites decides to publish them. 6 million, they paid 12 grand for them.
Okay.
6 million page views. Again, call it a $20 CPM. They made 120 grand off that
12 grand seems pretty cheap.
to get them.
Yeah.
Yeah. And so, like, that's essentially the media business of the past 25 years.
Yeah.
There's no barriers to entry. You get attention and you put ads against it.
Yeah.
And anyone was doing it.
Yeah.
Takeaway number 2, the platforms giveth and the platforms taketh away.
Very true.
Then in 2011, really, it all changes.
Yeah.
So you read through the first era, which is like the blogging era, where people have to find out about your website and go to your website. Then the Google SEO era lasts for about like 5 or 6 years. And then we move into the platform era. And Google's obviously still incredibly important. But for these media companies, the main source of traffic becomes Facebook and Twitter. And this is where BuzzFeed and Breitbart take center stage. BuzzFeed was just optimized for, you know, it was optimized for Twitter and Facebook over its own website, which was a massive paradigm shift even back then. And I think that's a really important learning for anyone who wants to be in media. It's like, jump on the changing trend and jump on it early. And that's really what they did. These are my words. They were BuzzFeed was a traffic pig. Anything to get traffic. Like, experiment after experiment, it worked. There was no rhyme or reason. It was like, if it got traffic, just keep doing it. They didn't care.
Did they pay for views? They would have surely.
I don't think so.
Really?
Yeah.
Through Facebook.
The guy that started BuzzFeed, Jonah Peretti, is like the king of going viral on the internet.
Right.
He also made Huffington Post what it was. He's sort of seen as like a whiz kid, I guess.
Yeah, right.
Yeah. BuzzFeed growth. 2011 to 2012, they went from 30 million unique views a month to 80 million unique views a month, from 4 million in revenue to 17 million in revenue. So, like, there's real money and real people here. But then all of a sudden, the platforms make a tweak and it kills your business.
Yeah.
And the example in the book that's really relevant here, do you remember the dress?
The one that was like, depending which way you looked at it.
Yeah, it was like gold and white or
yeah.
blue and black.
Yes.
Do you remember which way you saw it?
Gold.
Yeah, I saw it as gold as well. Yeah. BuzzFeed published that, and it was the most viral moment in internet history. And we'll probably never have anything that viral again.
Really?
Because the platforms all freaked out, and they realized that they couldn't control what they'd built. That was the moment where they were like, this was beyond us and beyond any of our ability to control it. And so then they put all these restrictions on content after that being able to take off like that again.
Wow.
Yeah,
Really?
Yeah. So the dress, and I think their logic, well, at least in the book it explains, their logic was, this time it was a harmless photo of a dress.
Yeah.
What if next time it's something that we just can't control,
Yeah.
but it's damaging?
Yeah.
So you can understand their perspective on it, but the tweaks that they made just killed a lot of these,
Virality.
just hurt a lot of these businesses.
Wow.
Around that time, 2015, 2016, 2017, a lot of these platforms realized that their traffic was becoming less valuable. They're having to do more and get more impressions for the same amount of money.
Yeah.
The correlation between traffic and revenue was breaking. BuzzFeed, so smart at this point, they raised $200 million at a $1.7 billion valuation from NBC Universal, right when they realized that they were in trouble.
Yeah.
Smart.
Yes.
But how's this for how big BuzzFeed was? At that stage, they had 1,700 staff across 12 offices around the world.
What would they have been doing in revenue? 2012, they were only doing 17 million. What were they doing at that point? Do you know?
I don't know, but yeah.
200 million at 1.7 billion
I know.
1,700 staff.
Yeah, I know. It's like all of the logic from the first learning, which is like there are no barriers to entry, low cost content wins. Then they seem to have forgotten in the second part, which was 1,700.
Far out.
1,700 staff, all making just like listicles and quizzes.
Yes, literally, the infinite quiz.
Okay, so that's the second learning, that in some ways you have to ride the hot platform, but they can also crush you.
Yeah.
And then the third learning, thinking about media as an investor, and is media investable these days? I think the learning from this book is as quickly as a lot of these media companies rise, they fall. The lack of barriers to entry means that any outsized profit is competed away really quickly. It's hard to have a moat or a sustainable competitive advantage. The lesson here is to capitalize on new technologies and new sources of traffic before they get arbitraged away, before they become more expensive or too crowded to capture. Two examples that I think tell the story of media as an investor. First of all, Huffington Post was all driven by SEO. They were just like, they nailed Google SEO. They sold for $315 million. They were getting 30 million unique website visitors a month. Jonah Peretti was one of the co-founders of Huffington Post, made tens of millions of dollars in the sale. He put 10 grand into Garrett Camp's car sharing company. Does that ring a bell? That's Uber.
Oh, right.
Yeah. Made twice as much from that investment in Uber as he did from the Huffington Post. Like, that is a story of the power of investing. Yeah. Didn't have to do any of the work to build Uber, made twice as much.
Wow.
Yeah. So that's Huffington Post. But then the second lesson is BuzzFeed. So by 2013, they were getting 130 million unique visitors a month. They were massive. They got an offer from Disney.
Oh, wow.
They got the Disney buyout offer. $450 million upfront plus $200 million in incentives.
Shit.
That was double what they'd raised at 9 months earlier. Like, this was like the Godfather offer from Bob Iger.
Yeah.
Would you take it?
Yes.
Yeah.
Well, hindsight's easy, but yeah.
They decided not to take it.
Oh, wow.
About a year later, they raised at an $850 million valuation led by Andreessen Horowitz.
Half of their previous.
No. So this was before that big one.
Oh, okay.
Then they do the big NBC Universal at 1.7. So at this point, you're thinking they did the right thing not taking the Disney offer. Then in 2021, they go public via a SPAC at 1.5 billion valuation.
Yeah.
So a bit off, but still much bigger than the Disney offer. Today, worth $90 million.
Jeez.
As quickly as they rise, they
that's
fall.
That's a wipeout.
Yeah.
They've gone to zero, essentially.
Yeah.
Wow, some great lessons there. Tough business to be in.
I know. It's a fascinating story. The book itself is a little navel-gazy in the sense that it's like, if you don't care about some of these websites and some of the people involved, it drags at points.
Yeah.
But it is an interesting history of the last 25 years of the internet and how much it's changed.
Wow.
Yeah.
Did they give an indication of where to next?
For the internet?
Like going viral, like where, platform, like the age of the platform, where that's going next. I guess probably written before AI was really having its moment, but
yeah, I mean, the big thing for me, the big takeaway is up until the last few years, everything was off platform. In the blogging age, you build an audience coming to your website. In the Google age, you use Google to drive traffic to your website. In the early days of the platforms, you use the platforms to drive traffic to your website. But it's really only in the last, call it 5 or 6 years, that it's now you can't drive traffic to your website.
Yeah.
Like Instagram make it near impossible. People aren't going off TikTok to go to your platform. No one uses Facebook for news or articles anymore. So it's just the whole paradigm has shifted. Like all of these businesses are struggling because there's a whole new generation.
Yeah.
It's companies like, the Daily Oz and stuff that are built to be on platform.
Yeah.
But then,
so much risk in that.
But then you go back to that second learning, which is the platforms giveth and the platforms taketh away.
Yeah.
And, Daily Oz dealing with Meta, thinking about news at the moment. It's like that's a classic example of that as well.
Far out.
Media's tough.
Media's tough. If you have a book that you'd like Ren to read, hit us up at equitymates.com/contact. But Ren, before they start flooding in, what have you got for next month?
So this was a very business-focused book.
Yeah.
This month, I reckon we go back to investing.
Okay.
I want to revisit a classic, The Little Book That Still Beats the Market by Joel Greenblatt.
Nice.
Yeah.
Nice. That's one I actually have read.
Oh, do you want to do it?
No. I'll be able to chime in a little bit on that one. But we're going to take a very quick break. And on the other side, Ren, you've got a wrap on the latest from JP Morgan's quarterly update. We'll be right back. Welcome back to Equity Mates Investing. We've just covered off everything that's been happening while I have been away and the latest book club. But Ren, to close out today, you went and spent time at JP Morgan HQ while I was away as well and got their latest quarterly update on where they see markets. What are the big topics that were covered?
Yeah, so four high-level topics, I think. The recent market crash.
Yeah.
The broader economy and where it's at. What next for interest rates?
Nice.
And then what's an investor to do amongst it all?
Okay.
So starting with the recent market crash, the big headline quote, you should be thinking opportunity, not fear.
Great.
Yeah. And their reasoning there was when prices fall like they have without any meaningful change to the macro or the micro environment, it spells opportunity.
Okay.
Nothing materially changed. It was just a bit of a weak jobs report and a bit of nervousness about a recession. But we kind of knew the recession was on the cards anyway.
Yes. Yeah.
They also think that sell-off was amplified by quants and trend-following models where models said sell even if the fundamentals didn't.
Yeah.
Another quote that I wrote down, the sell-off was a function of uneconomic sellers of their positions.
All right.
So people that are just following the models.
Yeah. Oh,
So
that's good to know.
That's number one. Number two, the broader economy. Struggling, but their most likely scenario remains a soft landing.
Okay.
Yeah. So they had some data. US jobs, unemployment, and job openings are just returning to pre-COVID 2019 levels. There's no doubt the consumer is feeling the pinch. This is US data, but credit card delinquencies are up and personal interest payments, ex-mortgages are also up. So recession is likely, if not already here. But inflation in the US is coming down. Personal consumption expenditure, which is the US's preferred measure of inflation, is at 2.5%. They think as growth slows, it'll hit the 2% target.
Nice.
So that's sort of like, are they threading the needle on the soft landing? Handbraking the economy enough to get inflation under control without tanking the economy.
Nice.
And
Well, now the commentary will be, they haven't gone hard enough on cutting interest rates.
Yeah. Anyway, well, let's talk rates.
Let's talk. Perfect.
So rates. JP's view across the world, like in Australia as well, is the next move is down.
Okay.
So it's just a question of timing. So they agree with the RBA projection that there'll be no rate cuts for the next 6 months in Australia, but then they think it'll be next move down early next year.
Okay.
Yeah.
Wow.
For the US, they think a cut in September. The only question is whether it's 25 or 50 basis points. In total, they think 150 basis points will be cut. So that would take the current range of 5.25% to 5.5% down to 3.75 to 4.
Nice.
Yeah. So they're like their big economic forecasts and takeaways. The question then is, what's an investor to do? And they noted that there's a lot of data showing that a lot of investors are moving to cash.
They are.
Moving to cash total investments in money market funds, which is essentially like a cash investment, you get a return on your cash, reached $6 trillion in the US. But JP warned about having too much cash. The numbers, 200 grand in a money market fund or a high interest savings account, call it 4.5% interest for 30 years, gets you 800 grand. Not bad.
Not bad, yeah.
But 200 grand in the stock market at the average return for 30 years gets you over $3 million.
Wow.
Yeah.
Wow.
And they asked the question, which I think is a good question. What do you think is more likely? The stock market average return continues, that average continues, or the savings rate stays at 4.5%?
You've got to go with the stock market.
Yeah.
Yeah.
A note on the correlation between stocks and bonds. For the last 25 years, they said that there was a negative correlation, so they moved in an inverse way to each other. But that correlation has broken. They think a lot of the economic textbooks are wrong.
Oh, wow.
They've just been written in the last 25 years. And if you zoom out further in history, you'll see that stocks and bonds generally are positively correlated.
All right.
If you're a big bond trader, I haven't
No.
fact-checked it. But I thought it was interesting. And then one other thing for investors, dividend investing, they've noticed, is like a big focus for a lot of people, income investing. But they made the point that you need to like every stock you own. Never own a stock you don't like just for the dividend yield.
Love that.
Yeah.
Yeah.
So I think that's a good reminder. And then a final note on what's coming next. The US election's coming up.
Yes.
They looked at data back to 1990. So that's 8 US elections.
Yeah.
Stocks decline pre-election and then rally post-election.
Regardless of result.
The only 2 times they haven't rallied post-election, 2000, which was then getting into the tech bubble bursting, and 2008, when we were in
Fair
the
enough.
teeth of the global financial crisis. So all 6 other times since Clinton was elected in 1992, decline pre-election, rally post-election.
Nice. That is one thing that I did keep an eye on while I was overseas, what's playing out in the US at the moment. It's just fascinating.
What are your thoughts?
Oh, I'm just so stoked that Biden handed the baton
Yeah.
over. Like, oh my God, thank goodness. I think the VP pick that she's done as well Tim Walz. Yeah, love that guy.
Yeah.
And I'm just loving seeing the Republicans and Trump squirm, feel uncomfortable now. Anyway, not to make it political,
we're not going to get political.
I did enjoy, well, I am enjoying seeing that. So much so that I've actually returned to watching some House of Cards. Because I was just like, I watched that at a time at uni where I probably knew less about the actual US politics and like the structure of it all and everything. And now I've got a much better understanding of it. So started going back and watching some of that and appreciating it a bit more.
Nice.
But anyway, thank you, Ren, for such a, I landed last night. You've come in with I'm fully up to speed now. Thank you. See how it all plays out from here. I just still can't see the RBA not raising rates, but we will see.
We will see.
We will see. And a big thank you to Simo as well for filling in my chair while I was away.
Yeah, some may say it's strange that Simo got to do 1 episode and then he's been exiled to England for 3 weeks.
True.
Bryce has reasserted himself here.
Well, anyway, I'm back. I'm ready. Looking forward to plenty more episodes to come. So thank you for tuning in. As always, if you got value out of today's show or any of the other episodes that you listen to, we would really appreciate if you could leave us a rating and a review on your podcast app. But Ren, thank you so much for getting me up to speed, and we'll pick it up next episode.
Sounds good.
Equity line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.